Hello, everybody. This is Steve from MakCorp, and we're doing a special podcast with Alexander Scanlon of Barton Gold, ASX Code BGD. And great to have you, Alex, and thanks for joining us.
Well, thank you for having us on.
So just a quick overview of both our companies. MakCorp provide market intelligence, analysis, trends, comparison and reporting on all the ASX resource stocks. We have over 600 data points in our system on projects, directors, financials, top 20 and more. And hopefully using our platform can help people make better informed decisions, and also for mining corporate finance people using for cash flows, etc. With Barton Gold, they're obviously listed on the ASX, the OTCQB, which is the venture capital on the US, and the Frankfurt Stock Exchange in Germany. And they're a developer targeting future gold production of 150,000 ounces per annum, with a 1.6 million ounce JORC mineral resource currently. And they own 100% of the regional gold mill and located in the Gawler Craton of South Australia. And obviously we'll hear a little bit more about Barton Gold via Alex. So do you want to tell us a little bit more about Barton Gold? Obviously you've got the two main projects in Tunkillia, which have just completed a scoping study, and the Tarcoola Project.
Yeah, that's right. So, as a very high level on Barton Gold, the strategy here was to identify a large scale regional gold play that we could capture, ideally with ownership of or access to existing infrastructure, and build something that is capable of becoming a much larger, longer term developer and operator. So we really like South Australia because of its geology. Where we are is right in the heart of the Gawler Craton, obviously a globally renowned geological domain. In the center of that, you have the IOCG iron oxide copper gold belt that is now effectively owned by BHP. They have their Olympic Dam project, which everybody knows very well. And they've acquired Carrapateena and Prominent Hill through their acquisition of Au Minerals. But that same basin, which is sort of deep and coppery in the east, becomes shallow and goldy as it heads to the west. So we've essentially consolidated every significant historical exploration and production asset in that gold trend. We've acquired the only gold mill in the region, and the strategy is to build up a staged, low-cost, lower-risk developer by establishing long-term bulk open pit baseload mineralization, which we've done at that Tunkillia project. Then looking at adding complementary higher grade mineralization to really enhance those economics, but then also being able to leverage some of that higher grade mineralization to start stage one operations using our existing mill. And therefore, we're targeting a 150,000 ounce per annum producer, not by jumping from 0 to 150,000 ounces per annum, but by going from 0 to, say, 25,000 ounces per annum very cheaply and simply generate
build a cash flow. Yes,
exactly. And then fund our growth to 150,000 ounces per annum as a matter of expansion, as opposed to one big giant leap, which of course has a number of other risks inherent to it.
And I want to highlight too, I believe you're in a very political friendly jurisdiction with South Australia.
We are, yeah. I mean, South Australia is a very, very well-known mining state, right? If we think about in the scheme of Australia, this is Australia's number one copper producer, and it is Australia's number one uranium producer. So it's kind of the Chile and Kazakhstan of Australia rolled into one state. Wow. And it's a state that's very, 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 very keen to see growth in not only the mining industry, but actually specifically in the gold sector, because despite the state's very substantial endowments as to gold, right? So South Australia has about 25% of Australia's known gold resources. It is greatly underrepresented in terms of production. South Australia only speaks for about 2.5% of Australia's annual production. That's really all byproduct gold production from the major copper mines. So they are very, very keen to see us essentially lead the reemergence of a primary gold industry in the center of South Australia, bring kind of that sort of central Gawler Craton area to life, and enhance the sort of prestige and profile of South Australia in another key metal for Australian mining.
And it couldn't be better timing with the gold price on the up too.
Well, that's exactly right. I mean, what we started building this strategy based upon a long-term gold price thesis. So my background is as an economist and a structured financier, and it's predominantly on the principal investment side of things. And, we saw a world going back into the mid to late 2010s, we saw a world in which, global corporate, consumer, and government credits, monetary policy, money printing, trade policy, deglobalization, conflict, all of these things were pointing towards the reemergence of gold as a risk-off trade, or at being remonetized as the world moves away from the US dollar. And all of these things that maybe seemed a little bit crazy 6 to 8 years ago are actually now unfolding very rapidly in front of everybody's eyes. So, I'm no longer the theorist saying crazy things on stage. I'm now surrounded by other people pointing to these things happening.
Which is following good. You, if you like.
Well, no, I mean, I think there are some very, very smart people out there who've been sounding kind of, similar warnings, as I have. But I think it pays to look away from the loudest noise in the current trend and actually look at the underlying facts. And the facts tend to lead the trend sometimes by several years. And the facts have been quite visible and quite obvious for some time. So, I guess my willingness is just, a willingness to say something different and be challenged. And that's an uncomfortable position to be in. But the net effect is that, the market seems to really, now be, coming together around realization that a lot of things are changing globally, that gold once again has a reemerging place in sort of international monetary theory and trade policy, and it is not some antiquated or quaint, cute little toy. In fact, the world as we know it, denominated by U.S. dollars, has only existed for 50 years. We are seeing a shift back to a pre-1973, pre-U.S. dollar as gold monetary regime in the global East or global South. And this is having really profound effects on the gold price. To your point, we are seeing central banks around the world stockpiling gold on the realization that if they want to be able to trade in the new emerging world order, or with the second pole that is emerging in between Russia and China, in opposition to a US-led US dollar hegemonic structure, they have to have gold. And more is the better. If they can buy their energy settled in their own export commodities with gold as this sort of net trade settlement, then they don't have to deal in US dollars, and all of a sudden life gets a lot easier for them. So
a lot more choice.
A lot more choice, and a lot is happening. And I guess where, the interesting thing is, this is where, the real world, so to speak, and the gold market is intersecting with kind of the economic theory, which is what I've been speaking to for the past several years. And the market's becoming aware of it. And it is all, I think, coming together, certainly into a circumstance where, again, central banks as the primary buyers of gold. If you have somebody who is a policy buyer, rather than a price buyer, i.e. they're not looking to make a short-term profit. They've decided as a policy they have to have it. That means they are price insensitive. You want to own the thing that the largest banks in the world have to buy as a matter of policy. And of course, we have seen a very difficult time for gold equities over the past several years. But now with this sort of re-emerging awareness of what is happening in gold and around the world, I think we're really poised we're poised for a very interesting time in gold equities because we have essentially, relative to earnings, all-time lows in gold equities and all-time highs in the underlying commodity. So it points to some very interesting years ahead.
Definitely agree. And I think with gold too, like if you look over the last sort of 10 years, there's been so many short trends with different commodities. Gold's always consistent. Whereas, you look at all the other commodities and they might have a 3-month or a 6-month or even up to a 12-month run. Then all of a sudden, supply and demand changes on, different commodities and it's up and down, but gold's always consistent.
Yeah, look, and I think that partly goes to the nature of the supply and demand relationship with gold, right? It is not, one of the common criticisms of gold is that it does not have a value in use industrially, so to speak, right? It's not used for electronics widely because of its cost, right?
Yep.
And people point to, say, silver as having a commercial value in use for technical applications. And that's true. Silver is really an industrial technical metal as opposed to a precious metal. It's valued by value. It is not a precious metal. It's just more precious by the ton than other metals. But gold, that criticism in some respects becomes gold's advantage because gold is kind of always in demand. It's always in demand as a store of value. It's really only the Western world, which has rotated around the dollar and the pound since the early 20th century, that has kind of seen gold as, not necessarily money. The rest of the world has always seen gold as money, has always reacted accordingly based on how the US dollar has or has not been pegged or related to gold, an actual reserve of gold behind it. And, we see a circumstance now where the Western world is starting to have to make, I guess sort of reconnect with how the rest of the world views gold. So it doesn't really matter that it doesn't have an industrial demand trend. If everybody needs something that is a dense enough store of value that they can recycle their trade surpluses into it, gold has a real place in the world again if dollars are no longer desired for that.
I agree. Now, let's get back to Barton Gold and tell us a little bit more. You've already touched on it about Barton's strategy.
Yeah, so for us, we built up that really strong position. The strategy for us was to build scale and then turn a multi-stage development. So we are focused on open pit material. Again, lower cost, lower risk to explore, for develop, and operate. But really also being able to target efficiencies, scale, right? If you can mine things in bulk, you can achieve lower unit costs. If you can achieve lower unit costs, you can achieve higher unit profits. Yep. And so what we're looking at doing is building a 150,000 ounce per annum gold producer on the basis of our assets as we know them today. We're focused on those Tarcoola and Tunkillia projects, as you noted. These are two assets that have over 3,000 square kilometers of ground between them. On that ground, we have around 100 kilometers of major mapped structures, and probably on less than 3% of those structures, we've now built up a 1.5 to 1.6 million ounce resource base.
Lots of opportunity.
Correct. So, and the opportunity is also in the optionality between these assets because they're very close to one another. So they're 70 kilometers apart. In reality, long term, they operate as one project. But Tunkillia is this very broad, continuous, shear-hosted mineralization. So big disseminated bulk, right? Big bulk open pits. Tarcoola, just to the north, is actually a much more complex gold field. This is where South Australia had its high-grade gold rush in the late 1890s. Actually, 1893, the same year that West Australia had its gold rush. And this is a series of shorter, shallower, higher grade structures that have produced high grade gold over the past 130 years. So if you have some big bulk open pit at Tunkillia and some complementary high grade material that you can sprinkle in from Tarcoola, together, these become a very compelling development proposition. But we also have this really interesting advantage in that we own a mill, which is just to the northwest of Tarcoola. And that mill has processed ore from Tarcoola in 2017 and 2018. So we have a fully permitted mill. We have a fully permitted mining lease. We have proven logistics, proven infrastructure, and proven metallurgy. And so whereas we're looking at this large scale, long-term 150,000 ounce per annum strategy, we can actually take some of that high grade from Tarcoola, put it through our mill, and essentially start a stage 1 operation. And we can, instead of
at a
going
low
from
capex.
0 to 100, correct. So we can go from 0 to 150, or we can go from 0 to 25, 25, 25, 50, 75, 150. That's really the strategy for us. And as you pointed out, if we can leverage that existing mill, an existing mill fully permitted, we are at least 2 years and $250 million ahead of not having that mill. We can restart that mill for a recommissioning cost instead of building that mill, and make that step from developer to producer at a low cost, re-rate our equity and our credit at a low cost, start generating free cash flow. That eliminates the need to go and raise capital on market. And then we can become self-funding. And we can also build up that war chest to then build our second project as an expansion that is partly or largely self-funded. And then whatever equity we do need to raise, we're raising a lot less and at a lot higher price.
And happy shareholders because of less dilution.
That's exactly right. We have a very strong track record of low dilution relative to most of the market. And partly that's because we already generate revenues that offset some of our expenses. But, that last 3 years of that track record demonstrates exactly why we want the next 3 years to look like this as well. Because that is how you get to the end destination, and today's shareholders are actually the beneficiaries of that success.
You've talked about sort of where you're at now, but what do you think your sort of main accomplishments have been outside of, say, the scoping study over the last sort of 12 to 18 months? Because looking from the outside in, you've done a lot.
Yeah, look, our first 18 months after IPO in 2021 were really about sort of demonstrating the proof of geological concept that we brought to the market. And now the last 12 to 18 months have really been kind of the rubber hitting the road as we've converted all of these theories into reality. So, when we're looking at, Tarcoola and Tunkillia, looking at Tarcoola, or sorry, I should say Tunkillia to begin with, that is an asset that started as a 500,000 ounce resource. We have found in the past 18 months, multiple new gold zones. We grew that to 900,000 ounces, and then 1.1 and 1.3 and 1.5 million ounces. We published that 1.5 million ounce resource in March, and then very quickly followed up with an initial scoping study to test our theory of the efficiency of development and operation at scale. And that came out really well. So
that's great growth in a short amount of time.
It is, yeah. Look, and the trick, of course, is always to be sort of looking and working a year to two ahead of where you appear to be at all times. And that requires you to do more things at all times, but it allows us also to just keep marching forward. The study that we put out, and we're careful to note that it's an initial study, but what it did is it showed us that at a 5 million ton per annum assumption around scale, that project can produce 130,000 ounces per annum of gold, around 300,000 ounces per annum of silver, and to do so at a very competitive all-in sustaining cost of around $1,917 Australian per ounce. Now, that does all of that only using about 60% of our resource, but it still delivers about a 40% unlevered equity IRR and a 1.9 year payback. And the key driver there is we've demonstrated we have this really interesting geometry, big bulk open pit with a higher grade central zone, which gives very strong cash flow during the first 12 months. So during the first 12 months, we actually would produce 180,000 ounces per annum. And instead of a cash cost of around 1850 or 1875, the cash cost is around 1250 Australian. So the first 12 months actually generates over $400 million in gross free cash flow.
That's
And
great
that gives
revenue
us
and
that
great profit.
correct. So that drives that really fast payback. It pays back all of our infrastructure costs in 1 year. And that gives us a very strong platform to now go and say, right, where do you take it? Where do you take it from here? Right.
Good
We
question.
are going to so we're going to optimize that project, right? So we've got that initial study. We had some very conservative assumptions around the crushing and grinding, the energy usage, the energy cost. So now we're going to come in and tighten up these assumptions to be more consistent with actual market costs and the actual inputs. We assume, for example, only single stage crushing of material that was 25% harder than our actual materials. And what that means is you end up with an oversized mill and you have to tumble things more and you consume more energy. So as we pull in the energy cost and we pull in the energy consumption, that will bring savings into that all-in sustaining cost, which is already very competitive. And we can push over into the mine plan and spread this out into something that looks more like a standard 9 to 10 year, 4 to 4.5 million ton per annum project producing north of 100,000 ounces per annum. And then we'll take that into feasibility studies.
Very
and at the
exciting
same
project
time,
and opportunity.
yeah, look, we certainly think so, right? We think that is really the start for that project. We're looking to create a district of bulk open pits around that Tunkillia project. We've got another 25 kilometers of untested shear there. So we do really think it's just the start. And then at the neighboring project, Tarcoola, we've added some ounces to the open pit, which is kind of a starting point for that stage one. And now we're out again exploring regionally. So we're creating these two large scale platforms that will each have their own mill. And now any regional mineralization that we find, that has a home, and therefore that mineralization is therefore much, much more valuable to us.
And you just had some recent results from Tarcoola too, which were very positive and high grade assays.
Correct. Yeah. So we drilled the Tarcoola open pit in March, and then we went over to test some of our theorized shallow targets around the Tolmer target in particular. And what happened is we did this was we sort of bounced along this sort of structural model that we had built up as a targeting model. And Perseverance Mine came back with some really interesting intersections. We ended up adding about 20,000 ounces or putting about 20,000 ounces of resource around 2 grams per ton right in the pit floor. We went and drilled at Tolmer, and then we went over and drilled at Warburton. And by the time we were drilling at Warburton, our infield analysis of what we were finding at Tolmer was really interesting. So we went back to Tolmer as well and back to Perseverance. And so we've had this sort of steady drill report. The net effect is we had this 20,000 ounces of Perseverance Mine right in the pit floor. We found a new gold zone or gold zones at Tolmer, which we are now following up. And then we've had some more recent drill results in the open pit where we think we'll be able to add further resources right next to those shallow resources we've mapped out. So kind of building these two projects up in tandem. And the idea is with Tunkillia, that is sort of, we look at that as, being the base for, the basis for years 5 to 15 of our company. And now with Tarcoola, the new Tolmer prospect and the existing mill, we're looking at, what are years 2 to 5? Let's crystallize that pathway towards a stage 1 operation. So if Tunkillia is the really long-term scale opportunity, Tarcoola, we build that up as a low risk, low cost step ladder up to that large scale operating platform.
So it sounds like you're speeding things up instead of slowing down. You've already done so much and a lot more coming. Do you want to tell us a little bit about your people, which, obviously you're putting a very good, strong team in place, and you're growing it early, which shows a lot of belief and vision in the company and your projects.
Yeah, that's right. So for us, really, and going back to before Barton Gold, we've had a very strong belief that, people really are the most important capital. It's the human capital. It's the most important capital in your capital structure. And, in Barton, we have built a team that in the leadership ranks has got somewhere around or north of 300 years of experience exploring for permitting, financing, developing, and operating major mining assets, with a very strong pedigree, both in gold, of course, important to what we're set out to do, but also in South Australia. So when you look at the gold side, pretty much about half of our leadership team are formerly of Normandy Mining, which was Australia's largest gold producer. In fact, the largest gold producer in the Southern Hemisphere until it was acquired in 2002 by Newmont. So this is a team that was really central to building up Normandy's development profile to a 2.5 million ounce per annum producer before to Newmont, and they went and joined Newmont. So we've got that very strong gold pedigree. And then on the South Australian side, it's really important to have a strong identity where you're operating. We are somewhat unique on the ASX in that we're the only kind of pure play gold, pure play South Australian developer of scale, which is, again, purely dedicated to South Australia. Now, this is really important for us in terms of identity and the support that we get from the local community, from the state, which has been a fantastic partner to us in terms of helping us, providing us access to resources, the geological survey, actually providing us grant funding for some of the more kind of riskier R&D work that we wanted to do, which has actually helped us accelerate some of these exploration theses. But we also have a team that is a South Australian team. So basically everybody except one of our non-executive directors, who is a mill specialist, and our company secretary, everyone is either South Australian or a long-term South Australian resident and based in South Australia. I'm sort of like the youngest transplant, and I've been there basically for 5 years, which is kind of a weird way of thinking about it. We've got a team of people who are very passionate about building something very significant in and for the state of South Australia and really leading the reemergence of the primary gold industry for the state. And that is, of course, something that is very attractive to the state itself, because it becomes something that's a real kind of flagship project or regional strategy for them. So that's really key. That's really key to us, and I think will be key to our success going forward.
No, looking at your people, and speaking to a couple of them recently, very excited and passionate about what you guys are doing. Mm-hmm. Let's move on to the financials, and I think this is one of the things for me that stands out for you as well, outside of the opportunity of the two projects and gold, is the fact that you spend majority of the money available on projects, and just in the last 12 months. You spent close enough to $7.5 million on the projects, which is extraordinary. That's when you look at the average, it's around the 3 mark, so it's more than double against other gold projects. So
look, sorry, go ahead.
Yeah, I was just going to say, so that's a huge standout for me, and should be to investors. And the fact that you've still got approximately 10 million in the bank, which will at least fund you potentially for the next 12 plus months.
Yeah, look, so on all of those points, we agree. If you want to make rapid progress, you have to be spending money, and of course the key thing is to spend it well, right? So we are good at being very efficient with the capital that we do have, and we're also sort of good at generating additional capital internally, which has provided our shareholders to date the benefit of much less dilution than you would find elsewhere. So, obviously, we are spending a lot of money, but what we've got, I think the key thing out of that is the results we've gotten out of this, right? So this
drilling, scoping study, you've done a lot.
Correct. Yeah. So we've put out, I think, three or four resource upgrades during that time. We published a scoping study. a lot of generative work to basically open up the future exploration pipeline. And now we're already charging again into growth. So we are really well funded to keep doing what we're doing. And in terms of our internal cash generation, this is something that does really set us apart. In the past almost 3.5 years since our IPO, we've only done 2 small placements effectively. And these have essentially been company-led placements to institutional investors who are really key to support our story. They've only been at very small discounts to market. We haven't loaded our corporate structure up with a bunch of options and warrants that would, dilute the benefit or the attractiveness to future investors, but the benefit to current investors. And so what we've done on that front to really strengthen that strategy is work the assets that we do have to generate that cash. So we produce gold ad hoc from cleanouts of our mill and small stockpiles. We dispose of surplus equipment. We rent our camps to third parties operating in the region. And so this has given us, we've generated over $10 million in net additional free cash flow internally doing that. And we are still continuing to look at, hey, are there other opportunities, other things that we can monetize right now? We're looking, for example, at historical tailings and stockpiles. So our plan is to continue generating capital internally as and where we can. And then in terms of future funding, obviously we are still a net cash consumer. We've built a very strong track record of raising what we need on much stronger terms than the balance of the market. So we will look as well, hopefully, when we're talking about a restart of operations in stage 1, because we have the existing infrastructure, that is something that we can actually securitize and actually look to use a significant component of credit, which of course is more favorable to the equity investors. So a lot obviously has been done. A lot will continue being done on that front. But we will also, we will certainly be focused on continued internal revenues.
So Alex, let's, we talked about some really critical parts of the project, company, and your people. I'd like to sort of highlight now the top 20 shareholders. Again, another critical part to the company. And you've got a strong holding of around 60% in the top 20, including, yourself and the board owning approximately 25%, which I think is huge in having that support behind you, sort of, going along in the journey, if you like, of what you're doing.
Yeah, that's right. Look, in our case, what we've seen over the past 24 months in particular is a very strong consolidation of our register around, board and management alignment. That's really, really key. That traditional principal agent dilemma that we all learned about in school. Board and management own around a quarter of the company. And we've had this very strong track record of consistent progress, consistent success, efficient use of capital, and low dilution. So that's, I think, got us, some very strong support from both the sort of institutional and sort of retail side of the register. On the institutional side, many of our largest shareholders are sort of well-known specialist gold funds, specialist project development funds. These include Collins Street Asset Management. They operate one of the most successful value funds in Australia, and they've built up about an 8% position. Merck's ASA Gold Fund have just under a 5% position. Ixios Asset Management out of Paris, about 3.4%. And then we have some other well-known names like Ballingal Investment Advisors, Cumulus Wealth, Mercer Street Capital, and even Primero Group, who are a mill developer with a 3.4% position. So we've got that very, very strong financial support, but also technical capability built into our team register.
Which is just as important.
Correct. And then on the retail side, oftentimes when you see kind of the wheel or the pie of the components there, when you're looking at shareholder structure, the retail component can often be kind of treacherous ground. A lot of companies have had multiple lives. They maybe have previously been a biotech shell or a copper explorer, and then they switched to gold, or they went to lithium. And, while certainly we understand, the attraction of going towards things that are more popular in the moment, there's a sort of a sting in the tail with that. And that's that you end up with a lot of shareholders that are now shareholders in a gold explorer who might have been part of a biotech shell previously, or they were interested in copper previously. So
exactly,
you have people who are not naturally at home in your register. Since our IPO is the only time we've done a retail placement, and we had about 500 retail investors at IPO 3 years ago. And today that's about 2,000 retail investors. So the only way to achieve that growth is for those retail investors to be buying our shares on the market. And that means
and I know you're focused on one commodity, and I think that's really important because, like you said, investors will go into one company that might have lithium as a priority, and if the lithium price is low, rightly or wrongly, they might go another, rare earths or copper or something else, and then those lithium investors are looking, going, well, hang on, what about the lithium project? So
that's right. People expect you, if you're a gold company, and then you go into lithium and you have a share price move upwards, that is basically a direct expression of lithium investors buying into your story. And then if you start going back over and spending money on copper or gold or rare earths, whatever it is, now you have a register that might be 50% lithium investors who are expecting you to spend money on lithium. And so you're actually not serving your shareholders well.
Yep.
And then they are going to find that no longer do they have a home inside your register. So for us, we've built a very, very strong register there where everybody
that is
wants
sticking
to be
with
there,
you.
and we are doing correct. And we are doing what we said we would do. We are doing it faster, better, and cheaper. And what we're seeing is not only very strong support from the institutional side, but very strong support from the retail side. We did a small share purchase plan, or we set out to do a $1 million share purchase plan alongside, a sort of increase in investment from the institutions. So we opened a $1 million offering, and that was over 300% applied within 5 days. So we had to close it quickly. But that's really the expression of support that we had just from within our own register. So we're really, fortunate, very grateful. It's very difficult to build a register that is that high quality. But I think we've done it, and we continue to see that strengthening as we go forward.
And you're proving it by doing what you're saying you're going to do. And I think that's critical, important.
Exactly right. Yeah. If we say, when I go,
because we see a lot of ASX resource companies do the opposite.
Correct. Look,
and sometimes it's for the right reasons, and sometimes for the wrong reasons. I don't judge any company that they're doing what they feel is right at the time, but it's very difficult when they're switching different commodities sort of, quite regularly.
Yeah. And of course, it depends what you're looking at and when you're looking at it, right? And what you'll find oftentimes is that, when gold is down and lithium is popular, the investors will be saying, do something else. And then, when lithium is down and gold is popular, they'll be getting criticism from the same people for having gone off to lithium and wasted time with lithium, right? So it is a very difficult thing running. Look, it is a very difficult thing running a publicly listed company, because you are subject to daily and sometimes hourly market pressures. And the truth is, you can't please everyone. But this is why we've really adopted the strategy of having a crystal clear mission, right? Gold in South Australia. We have stuck with it. We have delivered consistently, and we've built support from people who want to see us delivering a large scale gold project. And when I go to conferences, you sort of do the annual rotation of conferences. The feedback that we are getting from people is, hey, I saw you, 6 months ago or a year ago or 24 months ago, and you are the only company that I see every 6 or 12 months who every time I see you, you guys have done exactly what you said you were going to do, and you've done it faster, better, and cheaper. And I have not been diluted by 80%. So you now have my support and attention. And it takes a long time
That's
to build.
That's great feedback for you guys.
Yeah, it takes a long time to do that because you have to establish a track record. But
and credibility, which you're doing. Yeah, you've built credibility now.
Yeah.
Look, we'll look at why investors should consider investing in Barton Gold, and obviously you've touched on many aspects already with that. From project spend to your people to the projects itself in a great jurisdiction. Gold strong. Why do you think investors should consider Barton Gold outside of those sort of aspects?
Look, I guess for the reasons that we're essentially different to the sort of traditionally poor junior mining experience in every good way, right? And what I mean by that is we're kind of unique amongst these sort of general track record or our peers, as to a couple of key characteristics. One, again, we're the only pure play South Australian gold developer on the ASX. So we do have a very unique profile from which we benefit and we think our shareholders will benefit over time. Two, when you think about this profile we've just discussed, we are actually an advanced asset manager with existing mines, multiple properties, wholly owned processing infrastructure. Now, this provides us a much lower cost and lower risk platform to move into operations without that initial large scale, highly dilutive capital raising sequence. The third, of course, is that we have a team that can deliver that. So we've got a team that's highly experienced, but also highly aligned with shareholders in ownership. We have a 3-year public track record of low dilution, generating income from our assets, protecting our shareholders. And these things all come together to present this sort of particularly, we think, compelling opportunity for gold development focused investors. Our focus and track record today is creating and defending really significant shareholder value and delivering tomorrow's success to today's shareholders and making sure that today's shareholders are actually the primary beneficiaries. And this is something that's really unique to the traditionally much more dilutive junior exploration and development model or investor experience.
Well, I'd also like to add to that with your current market cap, which is sort of sitting around 55 to 56 million. I was once told, and I believe this, that if a gold company has got a million plus JORC resource, its market cap should be around 100 million, which I think is relative. And so that's you've got a 1.5 million JORC resource. So you're certainly showing great value as far as where your market cap's sitting at this point in time.
Yeah, look, we certainly agree, and as you say, it is relative, and gold equities have faced a lot of value compression over the last few years. But really, I think as you build up your resource base underneath that compression, as you see the long-term, short-term gold market factors coming into favor, and really this consistent pattern of steady progress, that's what really defines value. And I think this, we think that there's sort of a coiled spring forming underneath gold equities. And in all of this, we have worked very hard to essentially put ourselves on the front of what we think will be a rising wave over the coming several years.
Now, look, this has been a great podcast and great insight to what you've done and where you're heading. And I think for any investors considering Barton Gold at this point, visit their website, which is bartongold.com.au, and look at some of their latest PowerPoint presentations. And it'll also provide some slightly more insights outside of this podcast. But is there anything you'd like to add before we finish up, Alex?
Well, I think we've probably hit all the high points, all the middle points, and everything in the middle. So
I agree.
I think that's probably it for me. But thank you very much for having us on.
It's been a very enjoyable podcast, and you provided some great insights and vision to what you've done and where
Likewise,
you're heading.
Thank you.
Thanks for your time, Alex.